Hello, welcome back. Let's talk about income taxes. What I'm trying to do is show you this slide here. Hopefully it comes through on your camera. I'm over on page 198. I just find this chart interesting because it shows revenue and expenses for the government. If you'll note, this top pie chart is revenue. The bottom one is expenses. It just kind of shows where their money comes from. For example, income, Social Security, Medicare, and unemployment taxes, which we talked about, I believe it was just last week. Didn't we talk about that? 25% of their revenue comes from that. Personal income tax, 26% comes from that. Listen to this number. Over here, the dark blue. Borrowing to cover the deficit, 40%. Do you understand what that's saying? That's saying for every dollar the U.S. government spends, 40 cents of that dollar is borrowed money. You'll see a very small portion right here is corporate income tax. Excise tax is 5%. A little note on corporate, that little 4% corporate income tax. The United States has one of the highest corporate rate taxes in the world. You understand? One of the highest corporate income taxes rates. Yet we collect the least, if not the least, way down at the bottom. Why do we have such a high corporate rate and then collect so little money? Because of all the loopholes. GE went out and hired 55 corporate tax lawyers to figure out how to pay less corporate income tax. You know what that's saying is that it's less expensive to hire 55 corporate lawyers than it is to pay corporate income tax. I just find that interesting. That we have one of the highest rates and we're one of the lowest collecting countries. So that's where we get our money from. Social Security, we borrow 40%. Personal income tax, 26%. Let's take a look and see where it goes. Here's our expenses, the bottom pie chart. Social Security, Medicare, and other retirements. 34% of our money goes out to them. Wait a minute, something's not adding up. Look up here. We only collected 25% from Social Security and Medicare, but yet 34% is going out. How does that work? Social programs over here, the big blue one. 21% goes to social programs. 10% physical, human, and community development. On here, it's like a real light gray, almost blue. National Defense, Veterans, and Foreign Affairs gets 22%. Wait a minute. You'll see law enforcement here, 2% of our expenses goes to law enforcement. There's one missing. We always talk about stop sending money to foreign countries, but yet you don't see foreign aid on here at all, do you? The amount of money we send to other countries that everybody says we should stop doing accounts for less than 1% of what of our expenses. Foreign aid accounts for less than 1% of our expenses. So when you say cut foreign aid, you're really not going to affect your budget. You want to affect your budget, look at your social programs. Social Security, other social programs accounts for what? 55% of what we spend. You want to make a difference in the budget, cut these programs because they're your highest expenses. I just find that chart a little interesting. Taxes, we talk about 1040s, 1040As. Probably everybody by now understands what those are. Over on page 199, we talk about personal exemptions. We're going to look at personal exemptions here in a second. Just hang with me. Dependency exemptions. One thing we always want to talk about is taxable income. Make sure you understand when we say taxable income, you know what we're talking about. Taxable income may include a portion of Social Security payments, IRA distributions, pensions, and annuities. It also includes income from businesses, professions, farming, partnerships, rents, royalties, estates, trusts, and other sources. Note, it does not include income from gifts, inheritance, bequests, interest on tax-exempt state and local municipal bonds, life insurance proceeds at death, workers' comp benefits, and certain income items for veterans. So that one paragraph on page 199 tells you what it does include and what it doesn't include. Now, I'm no rocket scientist, but I'm thinking, I wonder if I'm going to see some of that again on an exam or something. I don't know for sure. I do know for sure, trust me. All right. Let's walk over to the podium and move the screen. Maybe. On page 199, you get a quick look at a 1040. You got your name, Social Security numbers, spouse. Here, remember, we talked about payroll. Here we talk about married, filing jointly. You can be single, married, filing separately. You have those choices. This is the filing status selection or section. 1040 exemption status down here. They have yourself and a spouse. This particular couple has a son and a daughter. So here they come up with, remember, mom, dad, son, and daughter is 4. Is 4. The fact that this family would have 3 kids, how many exemptions would they have? They would have 5, but they only list 2. Watch that. All right, on the next page, we talk about wages, taxes, our wages, tips, and all that. Taxable interest, you can see all this for yourself in the book. Down here, to line 37, we talk about adjusted gross income. We can do itemized deductions or we can do standardized deductions. Make sure you read all that on pages 200 and 201. And then over on 201, we definitely want you to see this chart. The chart on 201, and my friends, trust me, this is only for this book and text. Do not run to the IRS and say, hey, Miller said that the standard deduction for a head of household is $8,400. It's only good for this book. But here's the chart that we're going to need for the standard deduction for all our exercises. All right. Then, I don't know if I can get this, hopefully you can see this down here at the bottom. Computing taxable income. It will walk you through line by line. Total income for this person it was from the other page, $66,800. Total income, other sources, blah, 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 blah. They come up with taxable income of $35,800. This walks you through it. Again, you got a great concept check right here, 11.5. Walk through that. You'll see what we're talking about. All right. Page 202, determining the taxes due using the 1040. This is what it's all about, right? We determine the wages, we determine deductions, we do all that other stuff, we come down to just how much is due. For example L will walk you through it. Remember from the previous page, our taxable income was $35,800. Remember that? Schedule, and then they have to go to Schedule Y1. And we're going to jump ahead so you can jump back and forth these pages. If you go with me to page 203, and I'm sorry that even looks blurry to me, but that's all right. You've got it on your pages too. This is the tax rate schedule. It looks very similar to the one we looked at last week. Except this one you don't work right to left, or this way. This one you're going to jump around a little bit, but you're still going to need this. So, for example, let's go to example L on page 202. Remember, the taxable income was $35,800. Remember, from the page 199, this person was figure 11-4, married filing jointly. So we have to go to here, find married filing jointly. I see it as schedule Y-1, married filing jointly. Everybody with me? I had to get the married filing jointly from page 199, figure 11-4. That's how I knew what chart to go to. And then I find his income, how much was it? 35,800. He's right in the second line, it looks like to me. And then, note what it says. Tax on the first $16,750. So I'm actually looking at $16,750. The tax on it is, and what I did on the amount of the first 16,000, that's where I got it from, is $1,675. On the first $16,700 that he made, the tax is $1,675. So I know that that $1,675 should be entered there, and you see where it is, plus 15%. You see it right there, plus 15% on the amount over $16,000. Here's the key, my friends. You've got to remember to deduct the first $16,780 from his original tax amount. His original tax amount was $35,800 minus the first $16,750, and that's what, and it comes out to $19,050. That's what you multiply by the 15%. Don't forget to take that first of amount out of there. So let's say, this is just an example, that he made $200,000 taxable income. That would have moved him down to the fourth line. So the tax on the first $137,300 would be $26,687.50. Then I would have to take the $137,300, subtract it from his $200,000 taxable income. Always remember to deduct that right-hand column from the original taxable amount. And that's what gets taxed at whatever rate is in that percentage column. That's where most students get lost. They forget to deduct this amount from the original taxable amount. But this class is going to be different. This class is going to remember every time to deduct that from the original taxable amount before applying whatever percentage is in this column. You with me? Be sure to look at example L, look at example M. It's not difficult. You just got to remember how to work the numbers. The numbers are all given to you. Piece of cake for this class. Alright, then we're going to talk about credits for 1 second. I'm going to go to the next page. I'm already way long on this video and I apologize. One thing you have to remember about credits, a tax credit, deduction comes off your income. A tax credit comes off the amount of taxes owed. Two different things. Deductions come off your taxable amount. Credits come off of taxes owed. So, for the purpose of this text, and again, don't go running to the IRS saying it's $1,000. For our purposes, On 202, we talk about a child tax credit. Taxpayers with dependent children under age 17 can receive a credit of $100 per qualifying child. It says under 17. If the child is exactly 17, you do not get the credit. He or she can be 16.364 days, and you'll get the credit. But if the child is 17, you do not get the credit. And I don't know that that'd be that tricky, but there might be a question or two with children age 17. Not sure. And if they're 17, they do not get the credit. But go with me to page 204. You'll see here, line 54 is the child tax, or the child credit. Lines 54 and 44 and 45 is taxes due. This is what this particular couple would owe in taxes, $4,532.50. This is what they owe. If they had no children, they would write a check for that. But because they have a child under 17, it says right here the daughter qualifies as a dependent for exemption purposes because she is age 17 or older. Somewhere in here it says that we get credit for one person. Here's the credit. Remember, credits come off the taxes owed. So now they only owe $3,532.50. Deductions come off income. Credits come off tax owed. Very important to remember that. Alright, you can see an example N right there. This particular couple, if you're looking at example N, they have 2 qualifying kids, so they get a tax credit of $2,000. They did owe $2,650, but because they had 2 qualifying under 17 kids, now all they owe is $650. So that's the tax chapter. It's easier than what I made it out to be, I bet. Hope these videos are doing some good. See you next week.